Hi, everyone. My name is Kyle Arola, and I work on the distribution team here at Siegel, Bryant, and Hamill. For today's summit, we're going to be dissecting the high yield market so far this year, how it's set up to perform moving forward, and where we're seeing opportunities. Joining me today are senior portfolio managers Troy Johnson and Greg Shea. Welcome, guys. Troy, I'll start with you. With all the volatility we've seen so far this year in interest rates, how are the high yield markets holding up, and what have you seen year to date?
Thanks, Kyle. Yeah, high yield has performed very well relative to other areas of the fixed income market year to date, with a positive return of about 4.5%. This is despite rates moving higher. For instance, the 5-year Treasury, which is similar in duration to the overall high yield market, has moved from a 4% yield at the beginning of 2023 to approximately 4.8% here at the end of October. It's up about 80 basis points. High yield's performance illustrates the power of income and the yield cushion that the high yield market possesses. The market entered the year yielding just shy of 9% and had a duration of less than 4 years. The high yield that was offered in the market cushioned the underlying move higher in rates, resulting in outperformance and positive year-to-date returns. The same cannot be said of the U.S. Ag, which carries a lower yield and higher duration, which has resulted in negative performance year-to-date. Most importantly for high-yield investors, that yield cushion remains today. The high-yield market's yield to worst is slightly higher than where we started the year, at about 9.4% today, while it's still carrying a similar less than 4-year duration. Even the highest quality component of the market, the double B segment, offers yields in excess of 8% today.
Thanks, Troy. Digging a little deeper on that last point, how have the different rating categories performed in a year where stocks are up over 7% as we record this today? And really, the economic forecasters who were predicting a recession at the beginning of the year have been wrong.
Yeah, that's interesting, Kyle. Despite the wall of worry, triple Cs have led the high yield market higher all year long, which this chart shows. The year-to-date return of triple Cs is approximately 9%, and it has really outperformed the quality part of the market, the double B rating category, which has returned less than 3% so far through late October.
So, Troy, with all the uncertainty over the direction of the rates, the overall economy, seems a little unusual that high yield would be outperforming within the fixed income markets, and in particular triple Cs. Do you think that's likely to continue?
Well, time will tell on both fronts, but it's certainly worth questioning the outperformance of triple Cs during this period of uncertainty, volatility in rates, and rising default activity. As you can see in this chart, defaults have been increasing off of the lows from 2022, while spreads on corporate bonds, or the risk premium you receive in corporates to compensate for potential defaults, have been declining. This divergence between the two data sets suggests to us that we could see some surprises in the near future, as we expect the default rate will continue to climb.
Thanks, Troy. Greg, I'll turn it over to you. Let me ask you this then. You think the high yield market is set up to handle more volatility, if that is in fact what we do see?
Well, thanks, Kyle. And to answer this question, let's break down the fundamentals and how the market's positioned today, looking at both balance sheet leverage as well as interest coverage. Overall, net leverage levels at 3.6 times and interest coverage at 4.8 times compare very favorably to long-term averages over the last 12 years. The high yield companies have been able to lock in low rates during the low rate regime, and this doesn't look alarming. However, digging deeper, there are haves and have-nots. Looking specifically at the different rating cohorts, we see that the triple C rated companies at the index level remain highly levered and have low interest coverage levels today. These companies are not well positioned for higher rates and refinancing this debt. Let me explain. Cost of capital is higher today. The high yield market's cost of capital is more than double when compared to where yields were before the Fed started raising rates. And so what kind of interest coverage would you need today to refinance at these higher interest costs? Well, assuming that your cash flow and debt levels remain the same to where they are today, which could be conservative given your economic uncertainty comment earlier, a company's interest coverage ratio today would need to be in excess of 2 times to stay above 1x after refinancing all the debt at today's higher interest rates. Clearly, triple C's with their 1.3x interest coverage today could see pressure here, whereas the quality part of the market at 7x interest coverage is well positioned.
That's helpful, Greg. Thanks. So let's pull this all together. The high yield market continues to have an attractive yield cushion relative to its duration, like we discussed. But not all parts of the high yield market are prepared for volatility moving forward.
Well, that's correct, Kyle. And we continue to think the quality part of the market offers the best risk return over multiple different investment horizons. So for this analysis, we looked at the quality part of the market, which we're designating as the double B sector, relative to the overall high yield market, which has a mix of double Bs, single Bs, and those triple Cs. And we looked at 3 different time horizons, 5, 10, 30 years. You'll note that each of these periods has both times when the market's done very well for high yield and the market where we've seen sell-offs. This analysis assumes a $1 million initial investment, as well as an annualized 5% monthly withdrawal rate. The result, quality wins in all 3 time horizons.
Thanks, Greg. Troy, Greg, I can't thank you enough for breaking down the high yield market for us today. If you are considering looking into high yield for that extra yield pickup or reevaluating your current high yield allocation, know what you own in your portfolio. And whether you think there's going to be higher rates for longer or more volatility on the horizon heading into 2024, I think we all can agree that higher quality section or the double B part of the market is really where you want to be. So I want to thank everyone for attending this year's summit session on high yield. I hope you find it useful. If you have any questions or would like to discuss further, please reach out to your sales contact or visit us online at sbhic.com. Thanks.